Well, happy spring, everybody. Thanks so much for investing the time to meet with us today. We got about an hour. It won't be that long. We'll talk, Alma and I will talk for about 35 minutes. We invite as many questions as possible. This is an intriguing area, which I think everybody is very interested in. There's a lot of marketing and alchemy in this at the moment, and the whole world of crypto, a lot of people are confused about. There is a new vernacular. It's certainly different to the traditional financial system. So we're going to do some basics, and we're also going to drill into some much deeper elements. My job is to bring some zero objectivity about the progress that AYASDI is making. So, the real person to listen to is Alma Ngati. Alma is an expert partner at Guidehouse and a true expert in everything crypto. I expect to learn a lot from her today as well. So I'm really excited to get this started. So welcome again. Thanks so much for investing the time to hear a little bit more about what we're doing and what the market is doing. Our opinion is both of Guidehouse and of AYASDI and ourselves. So we are open to be challenged and open to receive as many questions as possible. I believe the questions can either be put in chat, or at the end, we'll open it up for verbal questions as well. So again, welcome. Delighted to have you on board, and look forward to a robust conversation. The crypto explosion, we're going to define that. And then we're going to really drop into, how different is this? Where are the challenges? And we're going to focus at the element of where this financial system is being exploited by both opportunistic and organized crime, and some of the ways that we can resolve this. And there is actually a lot of good news on how this can be managed once we really understand the concepts. The big thing that when we were looking into this and how we were so surprised is the adoption curve in the number of users in crypto at the moment is almost exactly the same as the adoption of the internet. We are truly looking at the introduction of a new and highly disruptive alternative financial system. We have to caution many of the traditional banks that are looking at this as some newfangled thing that the youngsters are doing with their surfboards and guitars, and really look at this and say, no, this is a significant challenge to the way the traditional intermediary is run. It is embryonic. There is still a lot of poor structure around it, but the innovation within this market is enormous, and the adoption curve is incredible. In fact, we're really looking at a democratization of the financial system. If we look at the demographics of the people that are really investing here, and remember, this is close to 16 million or 40 million Americans, or 16% of Americans have invested into this. We're looking at over 1 billion users of crypto, and not DeFi. I'm going to ask Alma to draw the distinction, just crypto by 2026. That is a significant trajectory. And I think that we're really looking at a very, very serious threat to the traditional intermediary in exactly the same way as we saw the internet disintermediate the large retail stores and traditional high street consumerism in the early 2000s. You add decentralized finance into this, and you actually have an adoption curve that is outstripping the internet. Almost the distinction between the two.
So that's a good question. And DeFi, decentralized finance, is a whole nother topic. So Simon and I were talking today that we'll do a deeper dive into that another day. But essentially, DeFi is decentralized payments that offer financial instruments without intermediaries like brokerages and exchanges and banks, by using smart contracts on a blockchain. So it is the same technology as cryptocurrency. It's a different use. There's often cryptocurrency involved in these transactions, but it allows me to get a loan from Simon without a bank in the middle, essentially, is one use case that we're already seeing. So that is another application that has a different level of challenges of regulation. that we can talk about more.
Yes, and I think if we look at the loan market, companies like Figure, Provenance, I think will be certainly looked at as market leaders as decentralized finance begins to pick up. Now, from a criminality perspective, which is really our focus at AYASDI, it really is a fascinating challenge. And so we're going to talk a little bit about, the types of crimes that we're really finding working with our clients. But the simple conclusion, number one, is we really do need to take this technology a lot more seriously than we have. One other thing I would talk about, if you look at the demographic of who is actually doing this, it's a lot of minorities, women, young people, people with poor credit. It really is, as I said, democratizing the financial system. And I think that gives the regulators a very difficult challenge, in that if it's over-regulated, they can disenfranchise a significant proportion of the population in an area that really is giving them a significant amount of freedom in the access to liquidity, in the access to loans, and the access to financial instruments that they've previously been not able to access. But on the bad news, as with any innovation, there are bad people that seek to exploit it. Now, we read a lot about the breakdown, and this is really a breakdown of the results of many of the projects that we're doing in what is the topography of crime. We hear about North Korea doing their thing. Sure, we hear about 20 to 25 oligarchs that are moving Russian money to try and avoid sanctions. Yep, that's happening as well. But the vast majority of these businesses, these criminal endeavors, tend to still be cash, and the most laundered and will continue to be laundered currency in the world will be the US dollar. The narco economy continues to be a cash-based business. Terrorist financing will continue to use the Hawala networks as their primary instrument of transporting funding. Tax evasion is a big deal as well, but really the two areas, given that as Alma often tells me, the ability to actually buy stuff with cryptocurrency is still very low. So the vast majority of crime is still within the closed ecosystem of crypto itself. So a lot of ransom scams, a lot of cyber extortion, a lot of direct fraud. When we look at Ponzi schemes, we look at pyramid schemes, there's a significant amount of activities that are really focusing at the naivety of the individual and exploitation of that individual. That is the vast majority of what we look at crypto crime. The good old-fashioned organized criminals, they still like cash, and they still like exploiting and arbitraging the existing traditional financial system. Now, will that change? Probably. But the good news is the regulators and the surveillance, monitoring, and compliance organizations within these entities have a chance to actually catch up or have a chance of actually getting ahead of organized crime as they begin to use this technology. Then on the sadder side, when people are treated as fungible units, they can easily be decomposed into frankly, a technology unit. We're seeing a lot in child pornography, slavery, human trafficking, and abuse of humanity as really being the second area where people, where we're seeing significant levels of organized crime, particularly coming out of Asia. So we have to look at the criminal topography in the use of crypto as very embryonic, that it is directly calibrated to the target-rich environment of the individual participants, and not necessarily the large organized criminal endeavors of the past who are so embedded in arbitraging the existing financial system that they're pretty comfortable without having to innovate into crypto. That will absolutely change, but this gives us all an opportunity to be able to get ready when these individuals or these organizations begin to use this technology. Alma, any observations on this?
No, I think that's absolutely true. And there's also an issue with the liquidity available to move large amounts of value through a cryptocurrency. Even the US government has said that while there will always be some sanctions avoidance in all segments of the financial institution, including crypto, it's not feasible for Mr. Putin to get around all of US sanctions by using cryptocurrency. The liquidity is not there, at least not yet. Now, they did take the interesting step of sanctioning a crypto mining operation in Russia to shut down that source of revenue for Russia. And they continue to do that. They've been sanctioning individual wallet addresses for a while now. But as a large scale method to evade sanctions, it's just unlikely to work. It hasn't worked for Venezuela either, who established a cryptocurrency called the petrol to avoid US sanctions, but then nobody accepts it. Right? So it hasn't proven to be very useful.
And certainly in the press is North Korea. Yeah, they certainly make some money. But when you think about the capacity of North Korea, in the entire country, they have about the same number of IP addresses as essentially a single block in New York City. So we will certainly see this, but again, I'm completely with Alma on this. What we're finding is criminality is focused at the participants rather than being used as any very large, globally wholesale organized criminal endeavors. I'll throw this to you.
Sure. And so I apologize in advance. It's hard to tell on webinars like this what the level of familiarity with cryptocurrency and how it works and moves. So if you already know some of the stuff that Simon and I are going to talk about, we apologize. So you can see that, and many of you probably know, if you have a traditional international payment, it goes through several correspondent banks from one country, say France to the US or Germany to the US. It takes a while to clear. Every single bank has a separate ledger, and so they know what's on either side of it, but they don't know the whole chain. It's expensive. It is difficult to trace, and all US dollar payments clear through the United States, which actually is a benefit to the United States because that's how they can see it. The data is private, and it has to go from a regulated financial institution to another. Now, that is the advantage of dealing with traditional fiat payments. And by fiat, we mean any official currency of a government, be it the US dollar, be it the euro, a yuan, that. So that is the advantage. If you are trying to take cash and transmit, say, large amounts of narco dollars, you have basically two ways to do it. You have to get it into a bank or a financial system, a money transmitter, and they are set up to identify large amounts of cash and file a currency transaction report, even if they don't think it's something suspicious. And if I don't want to do that, if I want to just give $1 million to Simon to pay for his cocaine, that's very bulky, right? It often gets.
You weren't supposed to tell anybody that.
Oops. But it's very bulky. When I was at the Treasury Department in the 90s, and we would put special geographic targeting orders to try to limit cash structuring, we saw an increase in cash seizures along Interstate 95, right? Because the money has to go somewhere. So if we go to the next slide, Simon, and we talk about distributed ledger, you'll see what the advantage is of distributed ledger, both to people and to criminals, regular people and criminals. So the transactions clear very quickly. So the compliance costs and redundancies are kept to a minimum. The payment is final, and that's a pro and a con in certain circumstances. And that transaction is traceable from the exception. So if it's like that correspondent banking payment, if you could see when it arrives on your books, when you get the Swift message, the Swift message has not only a description of every single client's transaction that makes up that correspondent account, but every place that it came from. It's like a $100 bill has a little GPS sticker on it, and you can see its path. Now, here's where it's a problem. So because I don't need an institution, and because it's not physical value, I can send that $1 million from my unhosted wallet to Simon's with no intermediary, with no entity to regulate, to say you have to identify the sender of this value. So that's where and because you can have an unhosted wallet with no KYC, a lot of cryptocurrency transactions are pseudo-anonymous. They're not entirely anonymous, and we'll talk about that, but they are pseudo-anonymous.
Mm-hmm. So just one point on this. This key here is finality of payment. Stimulates significant amounts of salivation from nefarious individuals. The payment is made, the payment is done. It can be tracked, but recovering that payment is exceptionally difficult compared to the traditional markets. So what does that mean for weaknesses that can be within this system that can be exploited for criminal opportunities? I wonder if you could elaborate on the unhosted wallets, Alma, given that you started that.
Yes, and that is as I said, that is one of the big issues with cryptocurrency transactions, is they can be accomplished without an intermediary through something called a self-hosted or an unhosted wallet. So many of you familiar with the big cryptocurrency exchanges, you can have an account there, just like you have an account at a bank, and they will hold securely your cryptocurrency either in a wallet in your name or in the equivalent of an omnibus account with value attributed to your name. I can have an unhosted wallet, which is exactly the same as keeping $10,000 in my mattress. No bank, no regulated financial institution, nobody has to approve me, no one has to know me. It's just in my bank and in my mattress, and I can send that to someone else's unhosted wallet. Now, because of this, regulators is a big area of regulatory focus right now, and there are several proposed rules out globally trying to deal with it that are not all that workable. So in the US, the proposed rule has two elements. If you send a certain amount of cryptocurrency to an unhosted wallet, the exchange, again, only applies to regulated exchanges, only to the intermediary. So if I have an account at an exchange and want to send it, they would have to file the equivalent of a CTR saying Alma Angadi has sent $10,000 to this unhosted wallet address. So the government will have access to that address. The Europeans have a proposed rule that would make that reporting required at any value. But the second part of that is the proposals want the exchange to have to identify and verify and identify that unhosted wallet's owner. So, and at $3,000 in the US proposal, at $0 in the European proposal. So, we got a question to explain unhosted wallet. That is a wallet that is not held at an intermediary at a regulated exchange. Think of it as just the cash in your pocket that nobody knows about, and I can give it to Simon and nobody knows about it.
Yeah, so whoever asked the question, that is for want of a better, melodrama, a bit of a KYC nightmare. Current wallets can be owned by the exchange and defined effectively. Unhosted wallets are remote from that exchange, and therefore it's a bit of a wild west. It's a significant exposure to actually understanding who the owner of that activity or that wallet is.
And the attempts to require exchanges to verify the identity of those, of an unhosted wallet, which is a person or entity they don't have a relationship with, is going to be very difficult from a practical standpoint.
Yeah, so there was a question earlier. Oh, sorry.
Yes, and somebody asked, do the exchanges bar payments to unhosted wallets? Not at this point. Now, and Simon can get into this when we talk about traceability and risk attributes of wallets. There is information that can sometimes be obtained about unhosted wallet addresses so that an exchange can identify that it is a risky transaction. Now, so they can, and Simon will talk about a little bit of that later. And Barry Koch has joined us, and he had a question, Simon. I don't know if you wanted to handle it about what the ledger actually looks like, the decentralized ledger.
Well, I think the question is does each Bitcoin have their own, or each cryptocurrency have their own ledger? And the answer, no. There are several blockchains, but those are really that's really the infrastructure that cryptocurrencies sit on. So there's public blockchains, I think there's 4 or 5 of them. But generally, the one point of consolidation around these cryptocurrencies is the distribution of the transaction itself, and that is within the blockchain, which is the ledger itself. So I don't know if you have anything to add to that, Alma, but the answer is no. Each cryptocurrency does not have its own ledger. It is registered, monitored, tracked and documented within the blockchain.
And so Jason had a follow-up. So it's easy for an unhosted wallet to integrate into the crypto exchange-based market. It can be easy, but again, the exchanges are looking for risk attributes. And as I said, there's technology that can identify risk attributes of unhosted wallets and that wallet's relationship to its customer, just like you would in traditional finance. I might have a very plain vanilla bank account, and suddenly I get a wire transfer from Cyprus. That's going to draw the attention of my bank. Just like if I have a cryptocurrency account and I get a very large transaction from an unhosted wallet, that's going to draw attention to me with my exchange and may very well result in a suspicious activity report being filed if it's not explicable.
Yeah, I agree with that completely. When we're looking, unhosted wallets are, it's not black and white, it's not binary, but an unhosted wallet is certainly something that adds a reasonable weighting into any risk model that's being analyzed.
And here's the other thing, and Simon talked about this a little bit at the beginning, because to make best use of the value of your cryptocurrency, you do have to usually have to turn it into fiat at some point. You have to, we call those the on-ramps and off-ramps, and those are typically regulated exchanges. Some are regulated better than others. And to turn it back into some kind of money. And that is right now, a good inflection point for identifying possible criminal proceeds. And this is a little bit of an aside, but the ability to review the blockchain transactions actually allows participants to understand the risk profile of an exchange, We do, for example, due diligence reports where we can look at the entire history of transactions through a particular exchange because it's visible on the blockchain. And I can see how many unhosted wallet transactions do they get? What is the size? What are their counterparties? What are the risks of those counterparties? Are they exchanges in a country where it's not very well regulated or not? So again, lots of information out there. It's different information than financial institutions are used to getting about a customer, but it can be quite valuable.
Now we're at half an hour almost, so we should.
I know we haven't gotten very far. I'm sorry.
Yeah, which is, and the questions are great. And if we roll over a little bit and people want to stay on a little bit, we will. Portability, I think we've discussed reasonably significantly, but it's intriguing. It's portable within the closed ecosystem. It is very important that the Alma comment about on-ramps and off-ramps, the lack of things to purchase remains a significant challenge for anybody that is using crypto as an exploitative asset class. So highly portable, a lot of movement from an opacity perspective within the ecosystem, but you still got to come in and out. Mixing companies, therefore, are often looked at, some people like Tornado Cash are often looked at as firms that increase opacity. Yeah, that is true, but the money is still leaving the ecosystem into a fiat asset class. So a lot of this activity, it's peer-to-peer. The transactions have finality. The access to the market using fiat transactions and exiting these markets using fiat transactions all mean that a lot of the crime that we're seeing within the crypto markets are targeting the unsophistication and naivety of current participants. So a lot of extortion, a lot of scams. That also means that the market remains significantly innovative, but highly fragmented. Bets on the right players is going to be, over the next 5 to 10 years, will really underline where we are going to see success or failure. It is completely analogous to the early 2000s of the internet, where some firms did extraordinarily well and have redefined us as societies, and other firms just frittered away. So there's a lot of money, and there is a lot of large institutions that are sitting on the sidelines watching to see where things go. The key to criminality is there is a significant lack of maturity and monitoring in surveillance. We like to think that we're leading our way. There are other firms like Chainalysis who we think are excellent, but it is very embryonic. So despite the very impressive transparency, because this is a technology-based financial system and therefore everything can be discoverable, monitoring and surveillance is still fairly embryonic, not necessarily because of the technology itself, but more of the adoption curve that we're seeing with many institutions. So many of the traditional institutions are still hesitant around where crypto and decentralized finance is. I personally believe that that is a mistake, and they should be looking at what happened to the large retailers, the large bookstores, the large entertainment companies in the early 2000s, because we will see a similar disintermediation model. What that means is, however, they still need to apply disciplined and rigorous compliance through their monitoring and surveillance. What isn't helping with this is some confusion in regulatory oversight. Alma's going to go through this a little bit more, so I'll jump on. But also the thing that we found when we first started this endeavor was a fear of a new vernacular. Guys, this is a financial system in exactly the same way as we've had a financial system for 200 years. There are some different words, there's some different assets, but fundamentally it is a financial system that can be easily understood. And the only difference is the clients tend to be defined as wallets rather than specific clients. And that has created some opacity, coming back to the unhosted challenges that we have. But I don't think there should be this fear of this new vernacular, because as compliance individuals, as financial crimes individuals, this is actually a fairly straightforward challenge for us, significantly easier than the cash challenges that we've been facing over the last 25 years.
And someone had a very good question. You can go on, Simon, about the travel rule, which is another interesting issue for crypto, again, because of the technology. So when crypto was designed, there is no mechanism for the information that an exchange has about someone transferring cryptocurrency to another exchange, because remember, the travel rule only applies to intermediaries. And so for several years, there was no way, it was actually impossible for exchanges to comply with the travel rule. There have been, coming online the last couple of years, maybe just the last 12 months, some technology solutions that are sort of the crypto equivalent of the SWIFT network to allow exchanges to pass on this information similar to the way that banks do. Again, this is that maturity curve that Simon was talking about. Everybody hasn't adopted it yet. There haven't been any enforcement actions about it yet. And the different technologies available have different levels of complexity and implementation challenges. So that's the travel rule issue. So that's a good segue into, as Simon said, this is the kind of traditional, it's a financial system like we've seen, but who's in charge of it? And I think the regulators have been correctly, having spent a lot of my career in different regulatory enforcement roles, they haven't wanted to impede the evolution of this technology, but at the same time, they have to be aware of the various concerns that they have, which include consumer protection, financial crime, and the health of the financial system. So you have a lot of players. You have the Financial Crimes Enforcement Network, who said that digital assets, if you trade them, you're a money services business. You have to regulate, you have to register, and you have to have all the different same compliance programs. Someone from an exchange was on a panel last week who said, if you look at my compliance program and you're a bank, it's going to look a lot like yours. Right? You have the SEC, which is contemplating how many of these digital assets are actually securities. They've said Bitcoin isn't, but there is some question. And then if we get into DeFi, they have already said that many DeFi products are in fact securities. The CFTC thinks they're commodities, and if you trade Bitcoin derivatives, you're subject to the CFTC. The IRS thinks it's property and wants to tax it. And OFAC, of course, treats it just like any other participant for sanctions purposes. And the finality of the transaction, Simon, has a particular impact on sanctions because you cannot reject a transaction. If I am an exchange and a sanctioned transaction comes to a wallet, I can't reject it. So they can only block. Now that's fine, and that's not been a problem so far, but that is the flip side of that.
Can I give an observation on the travel rule?
Please do.
It's a band-aid. It's a traditional regulatory response to a new market innovation. It will inundate investigative structures within the regulators. So you're going to reduce the volume by increasing the threshold, which undermines its purpose, or you're going to increase the volume and undermine the ability to actually see the wood for the trees. So I think it is going to be implemented, but we as participants in the market, whether it's in the fintechs, whether it's in the financial institutions, or whether it's in the regulators, need to look at surveilling, regulating, and reporting this technology framework financial system in a different way. And the travel rule is an example of us looking at it in the same way as a financial system that evolved over 200 years. We need to be more creative in solving these problems, because they will get away with it from us too quickly otherwise. Sorry.
No,
Yeah.
exactly. That's a great point. I'm not going to spend a lot of time on this. You may have to worry about FINRA obligations, especially if they're securities, and state regulators to do business, to sell cryptocurrency or market to customers in New York. You have to have a special license. You have to have a BIT license, and which has some special requirements, and DFS is very active in enforcement, as you know. So that's the complication. So I think we can
An
move on.
excellent question came about NFTs
Oh,
in
yes.
Q&A. I think the example of Melania Trump is a very good one. Yeah, NFTs is a wild west at the moment. You know,
so NFTs are not currently regulated. Many of the big exchange NFT platforms, though, are implementing basic AML controls. And the way that FinCEN changed the definition of who has to register in the Anti-Money Laundering Act of 2020 could allow them, I think, to cover NFTs. They haven't said that. And somebody said, are they similar to a multi-level marketing scheme? They might be, just like anything else. They kind of remind me of penny stocks, or frankly, the art market, which in the Treasury's latest report on money laundering through art, there's a section on NFTs. And Chainalysis, as who Simon mentioned before, they actually have a report where they have identified, because remember, it's also on the blockchain, it's also visible, the basically wash trading of NFTs to artificially impact the market, just like those of you in the securities field we used to see with penny stocks all the time.
Yeah. Yeah, and certainly on our side, we are treating NFTs as a high-risk asset class. They are highly portable, and they hold a high degree of value. In fact, they have a high degree of appreciative value, and so NFTs as an asset class, whether it be a security or whatever the regulators want to call it, are a significant component into the model, particularly as you see the maturation of the transfers of those NFTs from one participant to another. So multi-level marketing, yeah, but an excellent mechanism to maintain a high degree of high value portability to support a laundering or tax evasion activity.
And it reminds me, it can be similar to trade-based money laundering, because the value is difficult to ascertain. So if I sell an NFT to Simon for $50 million and he's paying me with the drug money he owes me, sorry, Simon, then, or I'm paying him with the drug money I owe him, we're both bad. You know, who's going to say that NFT isn't worth $50 million? It's like selling a piece of art or a container full of sneakers that could either cost $2 or $200. And so whatever you put on the invoice is the price, whether it really matches or not. So
yeah, and
so anyway,
you know, as we begin to reach conclusion, you know, the implementations we've had, you know, some of the traditional rules that you've been using in trade-based money laundering, in traditional fiat asset classes, are actually pretty applicable to a lot of the activities you're seeing in crypto. You know, you're still going to have this horrendous false positive problem, but the rules themselves, you know, do actually make a bit of sense in some of these asset classes or some of these activities, and we'll cover that a little bit further down the road on this.
And I want to get to the technology solution, Simon, so I won't take a lot of time on this. Again, investor protection, risk, market stability of the U.S. financial system risk, and illicit finance risk. And then also, I think the president's executive order focused on promoting U.S. Leadership in technology. And so these are all sensible things for them to worry about, as big bucket items for them to worry about. So I want to get to the technology because the solutions are the fun part. And we've talked about most of these things, I think, already, but it's here if you want to go over it.
Yeah, I think there's a couple of things that need to be covered on this. You know, there is a huge amount of participants. It is exploding in the number of people that are involved with it, but the number of criminal activities are still fairly concentrated. Certain cryptocurrencies as well. You know, for example, you want to go buy a machine gun on the dark web. If it's a Bitcoin, it's probably a federal sting. If it's Monero, it's probably real, because Monero does not necessarily, and it's certainly one of these privacy coins, and therefore it's fairly difficult. So if it's a Monero transaction, it's another element, red flag, that goes into your risk model. And I think some exchanges are trying to uncouple some of these privacy coins to get a better understanding. But at the moment, it's quite a binary analysis to say, if this transaction is using this crypto, there is a fair guess that it needs to be looked at harder. Now, the good news is, therefore, that we are talking about a reasonably transparent technology-enabled market, and therefore it is really well suited for a technology answer around compliance, around KYW or KYC, around understanding the transfer of these elements or these asset classes between participants. Liquidity remains a significant challenge. We've covered that enough at this point. And really, we like to think, what Alma was just talking about, is that the regulatory authorities are looking at this as a new disruptive financial system, rather than just as an adjunct to the traditional financial system. Now, breaking that down into two other areas around from a technology perspective, you know, our deployments, interesting. We look at AML and fraud in the same way. We see that fraud indicators are often causal for money laundering, and the same way around, as the same with internal collusion, as the same with tax evasion. To look at these as separate crimes is incorrect. To look at these as causal relationships within organized malfeasance creates significantly more opportunity to identify crime. So we break down the DNA of crypto, Framil. Interestingly enough, there is a decent amount of refocused rules in the market. We talked about travel rule, but also change of behavior, rapid movement of funds, you know, good old fashioned early 2000 rules that look for crimes from the 1980s and 1990s. Several of them still are quite appropriate in being mapped on the way crypto is being used. And the false positive numbers can be reduced because there is a lot more transparency within this marketplace than within the traditional markets. It gets more interesting. It's an example of one of the deployments we have. Obviously, we don't have any names in it at this point, but here, given the transparency, complex malfeasance supporting, you know, significant amounts of extortion, significant, you know, mostly coming out of Eastern Europe, significant amounts of child pornography, human trafficking coming out of, unfortunately, Asia. Looking at that, the nuance is needed to be able to find the inferences of these activities. This is no longer looking for a needle in a haystack. This is truly looking for a needle in a stack of needles. And so you're looking at aging, looking at the capitalization, getting a much more intimate understanding of the wallet, are all elements that can be applied into the model to discover these types of activities. It is not a binary, simplistic if-then clause in a rule. This requires a multivariate approach to really bring in not just deterministic, but probabilistic inference into one place and then calibrating it all. And this is where we're innovating to say, we don't want to just implement, forgive me, I'll use the travel rule. We actually want to give our customers the ability to really understand whether their system, whether their clients, and whether the framework itself is being exploited by not just opportunistic fraudsters, but organized criminal endeavors that see this as a true opportunity to exploit effectively and to actually get a higher pennies on the dollar return from their money laundering activities than they've had in the past. We have time. We are in a good place because of what Alma talked about, which was you can't buy a lot with crypto at the moment. But as that increases, as adoption increases, the opportunity for criminal endeavor is going to expand. And this financial system will certainly be ripe for targeting by more organized criminal endeavors. We need to be ready for that. And the good thing is highly transparent, always tracked within the blockchain, and therefore our opportunity to be able to control this from a compliance perspective should have a high degree of confidence, and a higher degree of confidence than trying to catch what it already is a horse that's bolted within the traditional banking system.
We got another good question about how to tell if a wallet is unhosted.
Do you want to take that?
No, I get, it's hard. That's all I know is that it's very difficult for the exchanges to do, which is another complication.
Yes, it is it is very hard. There's an age element within it. Unfortunately, I think we're going to have over 40 million wallets over the next year or so. So it is becoming increasingly opaque. There are some indicators around age that allows us to see with a reasonable degree of probability that it is unhosted. But I'm not going to share how we do that.
And sometimes you can tell that it's hosted.
We'll share it with you.
You can tell that it's hosted because your blockchain analytics, you can look up that wallet address in your blockchain analytics tool, and it is associated with an exchange, sometimes in a risky, high-risk jurisdiction, sometimes not. So it's a lot of proxy information sometimes that you use to identify the wallet and the risk. But that can be difficult.
I think it would be fair to say that the exchanges are our allies in unhosted wallets. In this case, Alma, would you agree that they are trying to work out? Yeah. So the exchanges will be very open in working with you in trying to get that transparency into it. So how do we do time-wise? Oh, 10 minutes to go. I want to thank Alma for joining me to sort of talk at a very high level and really get the dialogue on this technology and this extraordinary moment in the financial community moving. We're going to do a couple more of these further down the road. I agree. I think decentralized finance would be a very interesting one. I want to thank you all again for joining us for the last 45 minutes or so.
Simon, we have one more travel rule question.
That's what I say. Let's bring this home with some more questions.
Yeah. Oh, I'm sorry. I thought you were wrapping up. I
No, I wasn't
interrupt you. No. So is the travel rule being enforced? So at the very beginning, years ago, FinCEN said that the travel rule was in effect. They did not care that there was not a technology solution. The UK took a little different view, and they said, we won't enforce it. It applies, but we won't enforce it until there's a solution. There has not been an enforcement action involving the travel rule yet. Whether there's one in the hopper, we understand there are lots of, FinCEN has a lot of backed up enforcement actions in this area. I don't know that that's true. It wouldn't be terribly surprising, but they haven't enforced it yet, to my knowledge.
Yeah, they're a long way behind. I would draw your attention to something that the FCA published. I'm just looking at it. They did a consumer research paper last year, 2021, out of London. Their perspective as well was travel rule is interesting, but it is going to be very difficult to enforce. I still think, guys, that the regulators are still trying to work out the best way to establish an effective compliance environment within this. I think that many participants will be involved with that, including the technology and the companies and the exchanges. But I don't think there is consensus, and I think it remains very fragmented on what is going to be implemented. No control means lots of fun. Yes, Vincent, you're absolutely right. Yeah. But the saving grace, honestly, is you can't buy a lot with this stuff at the moment. So it's all sitting around within its own ecosystem, within its own closed environment. But we should not sit on our laurels with that. This truly is one of those moments that we will see a massive market change very, very quickly. And as compliance and financial crimes professionals, we need to be able to see the potential and where it's going to be exploited, and put the right technology and the right processes and the right organizational intellectual horsepower in place to deal with that. Otherwise, we will be pushed out of that market pretty quickly. Whether we wait for the regulators to tell us what to do or not, we need to be ahead of this problem.
We have one final question. Jason, you've been a great font of questions. Thank you for joining the presentation. What's to stop a front company or shell company from accepting cryptocurrency for purchases of a product? Nothing.
Nothing.
Just like a shell company can buy a condo in Florida or a house in London, right? There's nothing. The thing is that the shell company wouldn't have to get an account, but they would have to be able to use that cryptocurrency, turn it into fiat, and they would have to be able, in the due diligence with their bank or their exchange, be able to say what the source of that money was. And to be safe, they should probably be using blockchain analytics as well, although more than likely they would have, like a front company does now, have a bank account that would do the due diligence on the coins for them. So they would have to know their customer too. That was a bit disappointed. I hope that made sense.
Yeah, if you look at companies like Figure, Provenance, there's areas where it's really the loan side of the business is looking at crypto. They're having to do significantly more due diligence on understanding who exactly they're lending this money to, or these assets to. And so there does need to be a reasonably step up in the diligence and effectiveness of the technology that all of these firms are putting in place. What do you do first? You create alpha first. You drive innovation by creating alpha, and then you work out what the what the financial crime and exploitation exposures are. We've reached that stage with many of these firms. I think the exchanges are making some significant decisions as well. But the question is a good one. Nothing stops them. The question is the individual that's selling the house, they need to be part of the criminal endeavor so that you can convert that money into cash. And that's where the exposure comes. That's where we can, there is a very significant opportunity to catch that endeavor.
So I think we're at the end of time. This has been a really great webinar because we've had so much participation, which Simon and I really prefer because we want to talk about what you want to talk about. So thank you all. It's been really great, and we'll have more to come.
Yep. Yeah, no, thanks. Thanks for investing the time. We hope you found it useful. I think this recording is going to be published, and so you're very welcome to listen to it again and help yourself sleep, and look forward to seeing you all on the next one, where I think we'll talk about some other things and get a little deeper. So thanks for investing the time. Alma, thanks for joining me, and really look forward to chatting to you guys further down the road. Don't forget, if you want to understand it more, chat to Guidehouse. If you want to solve it, come and chat to us.
We work together a lot.
We do, yeah. So thanks again, everybody. Speak to you soon.
Bye.